Now, FirstRand has launched an asset management arm, Ashburton Investments. That's as banks around the world are increasing their focus on fee-generating asset and wealth management businesses as tougher regulations put the pressure on the core lending operations. Now, joining me now to delve further into the matter is equity analyst at Nedbank Capital, David Danilowitz. Hi, David.
Hi, David.
Let's have a look at the banking sector as a whole in South Africa. And we've talked so much about retail and resources in particular in the last month or two that maybe it's time just to remind ourselves where our banks are.
Thank you, David. I think it's important really to put the banks in perspective. I think right now we're facing a very challenging day on the market. The last few days, certainly a week or two, have been very challenging. A lot of uncertainty out there. I think it's important we try get a fair sense of the longer term picture. Certainly as a longer term equity analyst, we try look through cycles and not get too caught up in short term movements. But no doubt there's a lot of uncertainty, a lot of volatility, and that's never good for banks. The volatility and uncertainty feeds through to the consumer, feeds through to the corporate, and we're seeing that having an impact in terms of the potential growth profile of the banks.
What about the Rand? Let's start at the micro level of a thing like the Rand and how it affects the banks. It's been very volatile, trading at around 10.10 at the moment, but it has gone as low as 10.35 in the last 24 hours. This time yesterday was about 10.17. It's moving about a lot. How does that affect the banks, and what would investors be wanting to know about how that's going to affect their prospects?
So the exchange rate volatility we've seen is a big driver of the uncertainty, and clearly it's been driven by global flows, and certainly the question mark around our interest rate cycle in South Africa is being posed again in the last few days. So we're seeing the curves pushing up significantly. We've seen the most dramatic interest rate volatility than certainly traders on our desk have seen for many, many a year, in fact for many of them in their careers. So the volatility in the bond curves, in the bond market, in the exchange rate are certainly what's driving some of the uncertainty. The Rand implication on the banking shares, well, clearly the risk is we do see some interest rate hikes. The interesting aspect is that the interest rate cuts we've seen to date have actually not driven too much in terms of credit in South Africa. It's been pushing on a string to date. And so the other side of the coin is that high interest rates, in fact, do help banks in terms of higher margins.
Well, it's a double thing, isn't it? Because on the one hand, the higher interest rates are, it's more difficult for people to borrow. Lower rates generally would encourage mortgages, for example. But on the other hand, they generate income from higher interest rates for themselves.
In fact, totally true. And what's interesting is the growth we've seen in credit for the last certainly 2 years or so has been in the unsecured credit space. And a lot of that is on a fixed rate lending base. So the immediate impact on the consumer might not be there, but certainly as one moves up the income curve, there's still high indebtedness in the economy. And so higher interest rates is going to put more pressure on the consumer and on the corporate. And I think, as you said, the double-edged sword certainly hasn't helped the banks on the way down the interest rate curve because credit hasn't really expanded too much. And it'll be interesting to see if we do in fact face the risk of higher interest rates, what that will do to credit and economic growth in general.
What about the model of the business? Because that's one sector which has to worry about things that other companies in construction and mining and retail don't have to. They've got to provide capital for the economy. They've got to look after depositors' money, so there are all sorts of checks and balances there. And they also have to make money for themselves, which a lot of other listed companies have to do. But the other companies don't have to provide money to keep the economy moving. And we see in the US where they're trying to get the banks and people to use money, and they're not.
Yes.
So how are our banks sitting in terms of that equation that they have to worry about?
And I think that's important to put into perspective. Our banks are risk management at the top level in the world. We've implemented a lot of regulatory reform ahead of many other regions. Capitalization ratios of our banks are as high as any global peers. So we sit very well as a banking universe. And you talk about business models. We introduced with the soundbite around FirstRand and their launch of their asset management franchise. It's been an important step, and I think it's important to see what the banks have been doing. They've been trying to diversify their revenue streams away from purely lending towards other sources of income. And there's no doubt that the gathering of further customer assets on their own accord is going to be an important driver for the banks. We've seen this from a lot of the banks, and FirstRand now consolidating the asset management franchises together to try go further down this journey.
But they already have that kind of activity in their stable, don't they? So why are they creating this one?
I think it's important from a branding perspective and in terms of the journey from here. They very much do have those capabilities in-house already. And what you'll see now is a journey for them to try push further both into the retail space, which hopefully is higher margin, as well as broaden out in the institutional space.
Of course, there's a problem also with diversification, because one of the problems of the great crisis was that banks were doing too many things perhaps that they shouldn't have been doing, and that the risk that they took on also should perhaps not have been taken on, and then the contamination of the rest of the operation. So there's been a lot of talk, particularly in Europe. We escaped it. Particularly in Europe, about saying, no, you've got to go back to doing what you're supposed to be doing and separate the sexy stuff, the making of money through investment, into other operations.
I think it's a very interesting trend. We've seen global regulations which clearly will affect us moving in two directions. There's the too big to fail, and then there's a lot of regulation that's causing convergence in financial services as well. And we're seeing those affecting South Africa as well. So what we're seeing is actually banks moving into areas where traditionally life companies used to operate. And in fact, life companies moving into areas where traditionally banks used to operate. And so the blurring of the lines, and call it the shadow banking system, is emerging in South Africa, as we've seen happen globally.
Are there risks to this? Are they carefully considered, these risks?
I think no doubt our regulators are very aware of these trends, and the dynamics are nowhere as extreme as we've seen abroad. So I think at this stage it still remains reasonably good business practice. And I think the journey is to try and capture a greater share of your customer's wallet by providing better services and broader services to the customer. Certainly, if the trends get bigger down the line, this will be something that could concern regulators, but to date, I think the numbers are still small in the big scheme.
What about our banking shares? Any views there on, I mean, there's the big four, there are a couple of others as well.
So again, the last week or so, we've seen some dramatic movements in the bank shares. I think peak to trough, I'm not sure where we are currently right now, but certainly the numbers are not looking, there are not many greens on the screen there. Call it banks down 15% from their peak, more than 10% year to date down. So if one looks at the banks and the valuations of the banks, they certainly are looking reasonable valuations. Dividend yields approaching 5% looking forward. PEs moving into single digit territory as we move forward. And price to books have come down significantly. So
sounds all like a value proposition here. Time to get into the sector or not?
Well, I think the sector is going to face some challenges, but if one looks longer term through the cycle, no doubt I think the banks will come through any challenges looking quite good. Really what one needs to do is look at the current risk factors, and clearly there's an unsecured credit concern. This is affecting some of the micro lending players, African Bank, Capitec. The SA banks, the larger banks, have much smaller exposure to these risks, and so we're not overly concerned. We have seen Q1 impairment levels rising quite significantly, but overall we're not too concerned as a sector. We think the banks should find their way through the cycle quite comfortably.